$100 billion. That is how much trading profit a single fund generated between 1988 and 2018. Not a bank, not a corporation, not a government, a fund run by mathematicians, most of whom had never traded a stock in their lives before they joined, and in 30 years, not one person has figured out how they did it. Jim Simons was not a trader, he was a mathematician and a codebreaker, hired by the NSA during the Cold War to decrypt Soviet communications. Pattern recognition was his profession long before finance ever entered the picture. In 1982, he founded Renaissance Technologies, and he made one decision that separated everything that followed from every other fund on Wall Street. He refused to hire anyone from finance, no MBAs, no traders, no analysts, no one who had ever worked at a bank. Instead, he hired physicists, mathematicians, computational linguists, astrophysicists, cryptographers. His reasoning was direct. We learned it's easier to teach smart people about markets than to teach market people how to be smart. The fund he built, the Medallion Fund, named after the mathematics awards he and his early partner had won, would go on to become the most profitable investment vehicle in human history. Warren Buffett fell short of it. George Soros fell short of it. Every fund that has ever existed fell short of it. What it actually did here are the numbers. And pay attention because they don't sound real. The Medallion Fund averaged 66% annual returns before fees and 39% after fees for 30 consecutive years. The fees were 5% of assets and 44% of profits, the most expensive fee structure of any fund on earth, and it still returned 39% net annually for 3 decades. To understand what that means in practice, if you had invested $1,000 in 1988 and somehow stayed invested, that $1,000 would be worth over $90 million today. But here is the detail that makes this even more extraordinary. During the 2008 financial crisis, when the S&P 500 lost 38% of its value, when banks collapsed, when the global economy fractured, the Medallion Fund returned 98.2%, not surviving the crash, thriving in it, 98% positive. In 2007, during the quant earthquake that caused Renaissance's own larger institutional fund to lose billions, the Medallion Fund lost $1 billion in 3 days, 20% of its value gone in 72 hours. Simons let the models run, did not intervene, did not override. By the end of 2007, the fund posted an 85.9% return, but here is what most people miss. The numbers are not the insight. The insight is why those numbers are possible, and what it says about markets that most people never confront directly. Jim Simons made one philosophical shift that changed everything. He stopped asking why markets move. He started asking what they will do next. He said it himself. I don't know why planets orbit the sun. That doesn't mean I can't predict them. This is a profound reframe. Every other investor on Earth is trying to understand the reason behind market movements, economic theory, company fundamentals, geopolitical analysis, human psychology. They build models based on their understanding of why things happen. Renaissance built models based purely on what has happened and what patterns in that historical data predict what happens next. They analyzed market data going back to the 1700s. They incorporated signals most people would dismiss as irrelevant: weather patterns, lunar cycles, shipping routes, even the day of the week. Not because they believed these things caused market movements, but because the data showed these signals had statistical predictive value, even if nobody could explain why. And here is the most uncomfortable part of this for traditional finance. What you're really modeling is human behavior. Humans are most predictable in times of high stress. They act instinctively and panic. Our entire premise was that human actors will react the way humans did in the past. The market is not a financial system. It is a human behavioral system expressed in numbers, and human behavior, at scale, under pressure, is more predictable than humans want to believe. Renaissance built the machine that reads that predictability. Every major fund on Earth has tried to replicate what Renaissance built. None have.
And the reason is not the algorithm. It is 3 structural decisions that Simons made that every other fund was unwilling to make. First, he closed the fund. In 1993, when every analyst said he was leaving money on the table, Simons stopped accepting outside investors entirely. The Medallion Fund has been closed to external capital ever since. Only Renaissance employees can invest in it. A smaller fund with better performance beats a larger fund with diluted performance every time. He chose performance over scale. Nobody else has been willing to make that trade. Second, one model. Everyone works on it. Every other quant fund has competing internal teams working on separate strategies. Renaissance has one unified model, and every researcher improvement made anywhere in the system automatically improves everything else. There is no internal competition, only collective refinement. Third, the incentive structure. Every employee is an investor in the fund they are building. Improving the model by 1% puts millions into everyone's pocket simultaneously. That alignment of incentives between the builders and the beneficiaries has never been successfully replicated at any other firm. Jim Simons famously said, "When you discover a money printing machine, the last thing you do is scale it." Jim Simons died in May 2024 at the age of 86. He never fully explained how the Medallion Fund worked, neither did anyone who built it with him. The NDS hold, the models run, the returns continue. What he left behind is not just a fund, it is a question that the entire financial world has been trying to answer for 40 years, and hasn't. Not because the answer is hidden, but because accepting the answer means accepting something most investors are not willing to accept, that the market is not a financial problem. It never was. Now you know, the inflection